One of the most successful investors of all time, Warren Buffett, and his company, Berkshire Hathaway, have been lagging the performance of some of the largest fund managers in the world, such as Apollo Global and Blackstone, over the last 5 years. In fact, out of the top 9 asset management companies in the world, all but 3 have been outperforming Berkshire Hathaway. Why? Well, a large portion of these funds are made up of huge tech giants, exploding in share price since post COVID, with huge gains from Nvidia and other AI semiconductor industries, while Berkshire's only significant tech investment is based on Apple, not giving quite the same boost. Berkshire did invest in Google during quarter 3 of 2025, but this is only a recent purchase. So, given Berkshire has been underperforming large funds over the last 5 years, is Berkshire still competitive? Absolutely. Here's how. In Berkshire's most recent financial filing, they have provided a comparison of their performance versus the S&P 500 index since 1964 and have achieved a whopping return of just over 6 million percent versus the S&P at around 49,000%. The difference between that is like turning $1,000 of investment in Berkshire into 61 million versus S&P, which would have produced only 463,000. Still a lot, but nothing compared to the Berkshire's return of 61 million. So why is Berkshire not keeping up with tech stocks lately? Even though they've invested in Apple and actually have 298 billion invested in shares in 2025. Well, firstly, it's a relatively small portion of their total assets that are invested in equities. In 2025 annual report, only 298 billion in equities out of a total asset pool of 1.2 trillion, so around 25%, was invested in shares. And secondly, this is something that many people don't know about. Berkshire's core revenue stream is actually its insurance business, and not necessarily capital gains or dividends received through their share investments. In their full year earnings snippet, earnings from their insurance businesses earned close to 89 billion versus their equity investment gains of only 39 billion. In fact, this has always been the case for Berkshire for many decades. Look at this earnings report from 1977, almost 50 years ago. Insurance premiums then making up the largest portion of its earned income. Coming back to Berkshire's long-term performance, not only does Berkshire have an incredible return over the long term, but if we just zoom into the Dotcom market crash, for example, Berkshire doesn't actually see a huge reduction in its share price valuation. Again, simply because stocks are not its core business. So going back to the dot-com crash, as I was saying, which started in March 2000 and finally concluded in October 2002, look at the S&P drops of 9.1% at the start, 11.9%, and then 22.1% in 2002, while Berkshire sees a gain of 26.1% in 2000 and only a small drop-off of 3.8% in 2002. Why? Well, firstly, Berkshire only have about 30% stock position by the end of 1999. Looking at their 99 report again, their share of equity investments as a portion of their total asset base is minimal, meaning there was already some damage control in place with reduced exposure. Secondly, their exposure was mainly in non-tech related companies seen here. So does Berkshire hold a large cash position simply to purchase undervalued bargain securities and have reduced exposure to stocks like they did in 1999? Well, partially yes, but that's not the only reason why. Berkshire's insurance business actually requires significant capital on hand to ensure they provide insurance payout if required, especially where the payout could be large and with unusual risk. What does this mean? Well, let me give you an example of something Warren and his team have recently decided to do, and potentially a key play for the company in terms of additional revenue. With the Iran war breaking out in late Feb 2026, a huge disruption was brought about in the Strait of Hormuz. The Strait of Hormuz is a key transportation route for oil, and ships passing through this area account for roughly 20 to 25% of the world's oil supply and a significant share of LNG. As the Iran war started, shipping vessels were under higher risk of attack from missiles, unmanned aerial and sea vessels, and also explosions from naval mines. With this heightened risk, shipping companies or their owners needed more coverage from primary insurers. But these insurers only take on a portion of the risk. This is where Berkshire came into play. Berkshire essentially offered wartime risk coverage in this key maritime corridor, that is, the Strait of Hormuz. Primary insurers pass on a part of their risk to Berkshire. In exchange for a premium, Berkshire provides capital backing. This is where that huge cash stash comes into play. While many people believe it's simply sitting there waiting for buying undervalued stocks or private companies, another one of its key functions is to back this type of capital requirement. And of course, if no loss or damage actually occurs to the ships, Berkshire keeps the additional premium without having to make a payout. So when everyone else sees uninsurable risk, Buffett sees a mispriced insurance premium opportunity. So we are going through an interesting time at the moment where Berkshire appears to be underperforming some of the largest asset management funds in the world over the last 5 years, with the huge lift in tech giants engulfing ETFs under management by these funds, therefore boosting their performance. It remains to be seen how long these tech giants' share prices keep skyrocketing for. But in the meantime, just like they were in 1999, Berkshire appears to be at work under the surface, deploying and investing capital to enhance their shareholder value, potentially not showing their full hand as yet. As Greg Abel called out in Berkshire's most recent annual report filing, we focus on the long term, resisting temporary industry enthusiasms and exuberances. And this appears to be what Berkshire is doing at the moment. Thank you for watching. If you have enjoyed this video, please subscribe.